Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner alongside Mr. Alan Clopine. We've got a great segment lined up. Mike Fenison will be joining us shortly. He's the CEO and founder of Pure Financial Advisors, so stick around there. But one of the most important things I want to get through today is that we put together a free investor toolkit. This will help you understand what you should be doing with the overall investments that you've saved, how to create the retirement income, how to save money in tax, understanding risk and return. You know what? That's the only thing that's really related in the overall markets. The more risk you take, the more volatile the portfolio. Do you know how much risk that you're taking? The answer is probably no. Call the number right now and figure out exactly what your portfolio is doing. And the number is 888-994-6257, or you can always go to purefinancial.com. With that being said, let's see how you did on the true-false today.
Here we go. An index fund or exchange-traded fund generally holds many investments, which is good for diversification, and often has very low internal costs.
Yeah, that would be true. Ding, ding, ding.
That is true.
When we're looking at investment mistakes and looking at diversification, an exchange-traded fund, an index fund, a mutual fund, they hold hundreds of stocks inside that basket. So instead of buying one individual stock, you can buy hundreds of them at a very low cost if you use an index fund or an ETF.
Yeah, absolutely. And John Bogle had it right at Vanguard. Putting together funds that were very low cost, well diversified, and you just invest in them for the long term. But you don't just want one, you want to have several funds.
Yeah, and I think the problem, Al, with when people think of index fund or exchange, well, a lot of people don't really understand what an exchange-traded fund is, so we can probably dedicate a whole show on how it's packaged up. But when you hear index fund, it's not the S&P 500.
I mean, that is an index fund. That's one of them.
It's one of them. Yeah. It's one of many that you want to hold in a globally diversified portfolio. But then people get caught up in the hype all the time. It's like, well, what's the next IPO? Or should I get into Apple because iPhone 6 just came out? You know what? We put together something that you gotta ignore all of the hype that goes on in the investment world. Take a look at this.
Alibaba is creating a lot of buzz, becoming the largest company ever to go public, and prompting many to make the #1 mistake of investing.
I think one of the biggest things and the biggest mistakes people make is they invest based on their emotion. We invest based on headlines and media and what's going on at that given time, and that always drives us to make the wrong decisions at the wrong time. It's kind of the same thing that we've seen time and time again. You have that hot stock, whether it's Alibaba or Facebook or whatever the new company is going to be, which might be a good, great, strong company. But the important thing to understand is that everyone knows that, right? And it's factored in, and of course a lot of money can be made in IPOs, but a lot of money can be lost.
The success stories that help drive the emotional investing are stocks like Google. The stock could have been purchased for $100 in 2004 and sold for $597 in 2014. Apple could have been purchased in 1984 for $3.02 and sold for $336 in 2011. That's a 10,000% return. And Microsoft could have been purchased for 8 cents back in 1986. When adjusted for stock splits, it pays out in 2014 as $46 a share. It's the buy now or be left behind mentality that puts many people's retirement portfolios at risk.
We only hear about winners, right? So whether it's from a portfolio manager or a friend or a neighbor, whoever it might be, maybe especially us as guys, right? We tend not to tell you about what we didn't do so well, right? We want to brag about, hey, I invested in Apple before it went through the roof, or I invested in Microsoft early on, whatever it might be, not really referencing all the other stocks that I might have invested in before they completely failed. So we're only constantly hearing about the winners, but you always have to remember that there's a lot of other companies that haven't done well, for every winner that's out there.
Enron was considered a hot stock. It went from $90 a share to under $1 in just 15 months. That's a 99% loss. Bear Stearns and AIG stock prices plummeted and put many retirement plans in the red.
Especially when it's your portfolio and it's your nest egg, you don't want to take on that kind of risk that it would take to potentially earn, substantial returns, because risk and return are related. So in order to take a shot at achieving a huge rate of return, I have to take a huge risk in order to, attempt to achieve that. You don't want to gamble with your nest egg, right? There's just not the ability to make that money back again, especially as people near retirement.
Al, that's the biggest allurement of active management. When you take a look at some of these stocks, such as Apple, Microsoft, Google, the list goes on and on. When you see these huge returns, people get excited. That's that fear and greed. It's like, man, I want some of that. I don't want to necessarily be left behind. And so they're always looking for that golden nugget or that diamond in the rough, but it's so hard to actually find it.
Well, that's exactly right. And Joe, here in San Diego, remember it was Qualcomm a decade ago, 15 years ago? Everyone had to get Qualcomm. People that had Qualcomm and were working there, had stock options, were making a fortune. So we hear about this and we think maybe that's the way to invest, but we're here to tell you there are more failures or stocks that go sideways than the ones that hit home runs. But today I'm really excited because we have Mike Fenison, who is CEO and founder, certified financial planner of Pure Financial Advisors. He's also chairman of the investment committee. And Mike, we're going to talk a little bit about what we should do given all this noise in the market right now. And the market's volatile. So should we make any changes in our investment strategies given that the markets are kind of all over the place?
Well, the key word there is we, Al, and so I have to qualify the statement. The answer is no, we don't make a change in the investment policy. And the reason for that is that you have to know two things. You have to know how much risk is in your portfolio before you make that decision, and you have to know whether that risk is appropriate for your planning needs. And so for us, we know the answers to both of those, so we don't need to make a change.
So the first step really is to know how you should be invested in the first place. But once you have the right investment strategy for you, you don't necessarily want to make changes as the market fluctuates.
No, because you can't really predict market action. And the people that become most fearful about it are the ones that don't know how much risk is in their portfolio, and they hear the headlines and the hype in the media, which is all sensationalism that attracts attention, sells magazines and books and strategies, and creates new products to try to save the day. But in reality, there's no research that shows or even points to the fact that you can accurately predict the markets. And if you're going to try, you have to do it multiple times. Knowing when to get out doesn't help you if you don't know when to get back in.
Yeah, so how about this one, Mike, which is at this point in time, the press has a field day with the volatility. And so they come out, different people, different pundits come out and say, well, do this strategy, buy this. We've got this strategy for a sideways market. We've got this strategy when the market goes down. What do you make of all of that?
Well, all of those strategies will work some of the times if their predictions are correct, but all those strategies also incorporate costs. There's an expense to take any sort of hedging action against market direction. And what the research has shown is that that expense ends up being a net loss over time. So you might miss a short-term dip in the market, but it will cost you long-term total return. And that's why you want to have everything tied to your planning so that you know how much of a dip you can sustain and how much of a dip you could expect even in the worst of circumstances given how you're invested in your portfolio.
So planning first, figure out how you should be invested, and then stick with it. Rebalance is appropriate, tax manage is appropriate, but don't make wild swings.
No, all that keeps your risk consistent, and it needs to be consistent based on your planning. And if you're doing that and you know how much risk is in your portfolio and you know what the volatility might do to your portfolio over time, you don't need to make adjustments because any adjustments that you make will end up costing you. It'll be emotionally driven, and that usually doesn't work out.
All right, Mike. Well, thanks so much for everything that you've been able to tell us here today.
Thanks,
you know, when you take a look at the overall markets, right, you can absolutely beat the markets, the portfolio managers, but can they do it with any probability over a long period of time? Is it possible? But it's not highly probable.
Yeah, that's the key.
And so you want to make sure that you have the right strategy. So here's the deal. All you got to do is call our number to get your investor toolkit to make sure that you're not making the same mistakes that most people do with their money. Here's the number. Once again, it's 888-994-6257, and it's absolutely free. It is no cost, but the information is priceless. I stole that from a commercial, if you know what I'm talking about. All right, we got to take a break. Don't go anywhere. The show's called Your Money, and it's Your Wealth.